The stock market is a leading indicator of economic times. It's not a follower, it is a leader. It's all about trying to keep you guys focused and knowing that there's going to be a down day. Wall Street makes money by transactions. The more transactions you have, the more money they make. Welcome. Meeks is back there. I didn't see you back there. Probably everybody has been introduced to my son Taylor, Taylor Fike, and he just graduated from college 2 weeks ago with an accounting degree and is going to be the third generation in the Fike firm, and we're pretty excited about it because we do need some fresh blood in there, for our brains do get frazzled after a while. So right now he's doing a lot of grunt work, which I'm not so sure. He did say yesterday he feels like an intern, and I said, well, therefore interns usually don't get paid. So maybe you are an intern, and if that's how you want to be, then we can certainly not pay you. That's not a problem.
Negotiations are still open.
So anyhow, we've been having a little fun with that, but we're doing a lot of scanning and a lot of stuff that we wanted to do internally in our office. So for the next 4 or 5 months, he's not going to have a lot of fun because he's going to do a lot of grunt work, which is things that he probably didn't go to college to think that he was going to end up doing. But you got to start somewhere. And I want him to learn everything from the bottom up before he starts doing advising, which hopefully by fall we'll have him pretty well versed where he'll be able to start working with younger kids, and then I can start going on vacations 6 months a year, and he has to send me a check, and you guys will be okay putting up with the younger. They'll be smarter than us probably. No, we won't do that. I'll be like my dad. He'll be 80 in July and still comes in every day, so I'll probably do the same thing. So get used to that.
Oh boy. Good thing I love you.
Now, I can be paid to leave if I'm in your way, though. So tonight, we're going to talk about the new cost of capital. What is cost of capital? And in our industry, analysts look at what cost of capital is. Cost of capital is, first of all, capital is money. So what is the cost of money? So if I own a corporation and I want to expand my corporation, then I have to get capital from somewhere. I have to get money from somewhere. There's 2 ways I can do it. One is I can go in debt, go to the bank and borrow money. Come on in. I can borrow money, and if I borrow money from the bank, my cost as the guy who owns the company, say I make widgets and I want to make more widgets, the cost of me borrowing that money from the bank, I have to pay interest. That's the cost of capital to the corporation or the company. And on the flip side of the cost of capital then is the investor. So I can either go to the bank and borrow money and pay interest to borrow that money, or I can sell shares of stock out to the public or to private individuals, and I'm going to have a cost there, right? Because that's the investor. The investor says, look, I'll give you money, but I need to get something in return. So the cost of capital story is probably the heart or the cornerstone of capitalism or the free market system, because it's us building companies, growing companies based on buying and selling of goods, and to grow that company, I got to have more capital infusion. How do I do it? So I either go to the bank and borrow. If I don't want to go to the bank and borrow, I issue shares of stock, and I sell stock to investors, and those investors expect some kind of return based on the kind of risk. So if I'm this big, giant, large company, and I want people to, and I'm a Fortune 500 company, everybody's heard of me, then you can expect a less return, so to speak, if I'm going to invest in that company, because I know that Coca-Cola or some large corporation's good, solid company, as opposed to ABC of Podunk over here, who nobody's heard of. If I'm ABC of Podunk and I'm trying to raise capital for my company, I might have to pay more money to the investor or to the bank in a higher interest rate, because they really don't know me. They don't know if I'm going to be around 5 years from now. So The story we're going to talk about is cost of capital, but more so on this cost of capital, it's, since we're all investors here today, it's how does the investor look at that cost of capital, okay? So there's really a couple aspects to this. One, I'm going to go just kind of reiterating what I just said. Cost of funds that a company raises and uses, and the return that investors expect. So I'm the corporation guy, and I got to figure out what it's going to cost for me to raise this capital, and how much am I going to have to pay investors to get them to invest in my company. And then the other side of the coin is, if I'm the guy at the corporation level, I got to figure out what my minimum return in my company is going to be, so that it gives me enough cash flow to be able to pay those investors back, not just their principal, but interest or earnings in the form of dividends or whatever might be in shares of stock. So whenever this happens, it's very simple. If you say, I'm a guy that owns a corporation, I need to raise capital, I go out to investors and say, look, invest with me, you should expect an 8% return on our money. If we do well, that's what kind of money you're going to get. But there's a whole lot of costs involved in all this, because it just isn't that simple, where, you know, the corporation comes out to you guys as the investor and says, invest some money with me and you'll make money. It's not that simple. So we got to look at what the costs are. Well, there's two problems with all this raising capital, and basically now I'm looking from the investor side of this whole thing. I'm going to invest money with this corporation in the form of stocks. I need to know how much it's going to cost me to do that. So those are what we call hidden costs. And then what is the behavior penalty to do that? Okay, so what we're going to talk about, since most of us don't invest individually in stocks on a regular basis because it's a lot of work, we don't do it. We used to do some of it, but we don't do a lot of it anymore. Everything is mutual funds. So we're talking from the investor standpoint of going through mutual funds to invest and help corporations grow. And that's that help with that capital that is needed, infusion to these corporations. So the hidden costs of mutual funds. So Wall Street did this study here a couple years ago, and they said that we're just going to talk about U.S. stock funds. The average cost, or a management fee or an expense fee. So if anybody ever gets their prospectus from a mutual fund, it always has it lists in there. I know they're fun to read, but it lists in there what your expense fee or your management fee is. Or if you're in a 401k, it usually says this expense fee is 0.86, 0.87, 0.41. They're all over the place. But the average is 1.31, which is pretty high on the average side of it. I mean, you can buy mutual funds that have a lot less expense fees than that. And this is according to Morningstar. The U.S. stock funds pay an average of 1.31 of assets each year. So that means I'm paying 1.31s coming out of my return on average to pay the fees of this operating this mutual fund. Okay? But there are other costs besides the expense fee. The expense fee is the only thing that they have to disclose to you. And those we can read in every little prospectus if we look, or we can go online and look up a mutual fund. It'll tell you exactly what the expense fee is or expense ratio. But what we can't find is the cost of buying and selling securities in a portfolio. Okay, and so these expenses can make the fund 2 to 3 times more costly than that actual expense fee. So we're talking about actively traded mutual funds where there's guys buying and selling all day long, and so they incur trading costs, which do not, by the way, have to be disclosed by the SEC. Does not require them to disclose those. So if we look at mutual fund fees, our explicit costs are what we see. So it's kind of like the tip of an iceberg. We can see, we know what the mutual fund expense is each year by looking in the prospectus or online, but we don't know what's underneath. We don't know those trading costs, those hidden fees, those expenses that are incurred. Those are implicit costs or implicit fees. These are the fees that we don't know what they are. So we know what the explicit fees are. There I go again. We know what the explicit fees are. We don't know what the implicit ones are. So Steve Horan, this is the Certified Financial Analysts Institute. He's the head guy there. He said these trading and transaction costs are very real. While it's very important to look at the expense ratio, it's just not going to capture what the actual costs are. So the expense ratio being that mutual fund fee that they have to publicize, it's just a small piece of what the real costs are. So Mr. Horan estimates that trading costs for stock funds are 2 to 3% of the assets annually, and conservatively at 1. So if you take, let's assume that 1 is a conservative figure, 3 is the top of the figure, somewhere in between. We're somewhere in the high 1s to 2% just in trading costs that you will never see when you buy these actively traded mutual funds, because they don't have to disclose it. Now, some of them do. You have to look maybe 50 pages into the prospectus. You might see other expenses in there, but it won't disclose exactly the number. They don't have to. It's very hard to find. In fact, when we were all with American Funds, when we went to move over to the Matson portfolios, we met with the American Funds rep. And I asked him, and Dad's back there laughing, I told him what we were doing, and I said, where are the trading costs disclosed in there? He goes, well, that's simple. It's right here in the prospectus. I go, show me, because I can't find it. Well, by the time the end of the conversation was, what, a half hour of him fumbling around, he goes, hey, I work for American Funds, what am I going to say? And I go, well, so you're telling me that they don't have to disclose it? He goes, no. I go, that's what I was told. I'm just trying to, this is when we were trying to figure all this thing out. So the trading costs are horrendous. We just don't know it. And where do they come out of? They come out of your returns in the end, okay? You aren't going to see those come out of your mutual fund, but it comes off the top. So this is quoted out of March 1 of 10 Wall Street Journal. So when it says a study updated last year, 2009, of the thousands of U.S. stock funds, the average trading cost at 1.44 of the assets. So that means the trading costs on average in this study was 1.44. So remember back there in that last slide, I said 1, 2, or 3. This is Mr. Horan speaking. Then the Wall Street Journal's article says that it really is 1.44, and they're getting this off of Morningstar. I think is where they're getting this information. And Morningstar, by the way, is a third-party institution, for lack of better words, that collects all data on all mutual funds. So if you ever want to go on the website and look up a mutual fund, you go into morningstar.com and it'll tell you just about anything you want to know about that mutual fund, except you won't find the trading costs in there. So 1.44 is what they're saying. This guy's Richard Evans from Darden School. He's the University of Virginia, says expenses are one of the most important things investors can look at. Trying to quantify a fund's trading expenses can be about as easy as performing brain surgery. So you have your typical stock investing for dummies book, right? And then it has its little components, brain surgery for dummies. And the point here is that even though we all know what a scalpel is, it doesn't mean we know every detail or we should be performing brain surgery. But however, we do know, everybody knows what mutual funds are, but we don't always know what that mutual fund's made up of. So just like a scalpel, we can be very dangerous to ourselves if we don't do our homework and look in these mutual funds, these actively traded funds, and see what's really going on. So what are the costs? What are the real costs? What are the problems? Well, we have brokerage commissions. We have bid-ask spreads, which we've talked about before. I'll talk a little bit about today. We have opportunity costs, and we have market impact costs. So these are 4 things. These are hidden costs we're talking about that happen in these actively traded mutual funds. So if we start with brokerage commissions, Putnam Investments, for example, the Putnam Voyager Fund, which is a large mutual fund, reported at the year end, July 31st, 2009. I tried to get one for last year, but I can't find it anywhere. So I don't know where they got this information at. They're very hard to find, but they reportedly claimed $21.5 million just on that mutual fund in trading cost commissions. It's amazing. I mean, we're talking billions of dollars made every year in this industry for trading. And we're going to talk about how that all happens, but it's huge trading costs. How can we eliminate that in our portfolios? This is what Dad and I went through a few years ago. How do we eliminate all this trading? Because this is wasted money. It's people trying to beat the market, and it doesn't always work. So brokerage commissions, the SEC doesn't require that these commissions be disclosed. I said that earlier. So when you see the expense ratio, it does not have trading costs in it. The second thing you got to look at when you're looking at a mutual fund some of the hidden costs, and you're not going to find this anywhere either, is the bid-ask spread. And I've talked about this earlier. This is a very simplified approach, by the way. Let's say I have 100 shares of a stock and it's at $50 a share, and I go to sell it, okay? I can't just sell it to you. I got to go through a market maker. Somebody's going to have to handle that transaction. I can't just sell it back and forth to each other. We can't do that. So if I have stock that's $50 a share, there's a sell price of $49.50. That means if I have 100 shares and I call up a broker and go, I want to sell my 100 shares of XYZ, and I go, it's worth $50 today, and they go, oh, no, I'm sorry, it's worth $50 if you're buying it, but it's $49.50 if you sell it. There's a market maker, the guy on Wall Street down there on the floor, who's a market maker, is going to make a little bit of a piece of the action, and then you're actually, you're going to sell it for $49.50. If 2 hours later you want to turn around and buy it, you're going to pay $50 or whatever the going rate is. So this is a simplified approach. It may only be 1 or 2 or 3 or 4 cents difference, but this is just an easy way to look at it. So these are called bid-ask spreads, which exist. So not only do we have brokerage commissions in this actively traded mutual funds, we also have bid-ask spreads. So that's another added fee into this 1.44 average expense in a mutual fund. So often the largest component of trading costs, as much as 1.5 times the brokerage commission. So you got your commissions, and then you've got your bid-ask spread fees. Then you have market impact costs. Now they say market impact costs are the highest cost in trading mutual funds. Now we're talking mutual funds that are buying and selling stocks in very large blocks. Okay, they're not selling 100 shares, they're not selling 50 shares. They could be selling 50,000 shares or 100,000 shares or 20,000 shares. We're talking large quantities of shares of stock that these mutual fund managers are selling. So what a market impact is, and they're saying here it's 1.5 times what the commission is, so it's one of the highest costs. But what it is, if I am a mutual fund money manager and I got 100,000 shares of XYZ Corporation and I want to get rid of it, okay, but I got to be careful, because if it's not a highly traded stock, if it's not one of those real popular stocks, and I want to sell those 100,000 shares, by the time I put my order in to sell it, and by the time it gets sold, the price will drop, okay? Because when the order goes in, and if you guys watched 60 Minutes there, a month ago, they talked a little bit about some of the nanosecond trading and how whenever you put a sale in, and sometimes all the orders don't get fulfilled, that's opportunity cost. But market impact cost is I might put my order in to sell those 100,000 shares as a mutual fund money manager, and the price drops. Now all of a sudden when it actually sells, it might sell for 50 cents a share less or whatever. Now I just lost money for my investors. So this is probably one of the hardest things when you're a big money manager, is how do I unload something if I'm actively trading? And these guys are doing it all day long. The other piece is opportunity costs. And what an opportunity cost is, anytime I buy a stock or sell a stock, there's somebody on the other end of that trade. Okay, so if I'm selling stock, whether it's 100 shares, there's somebody somewhere else that's buying that stock for 100 shares. Has to be. I mean, it's just you're selling something and you're buying something. There's just a lot of people in between that make money on it. So if I'm selling 100,000 shares of XYZ, and there's nobody on the other end that wants to buy 100,000, I might only be able to sell 50,000 shares. Okay? So now I'm stuck with the other 50,000 shares. If the stock price is going down, now I'm losing money. This is opportunity. It's a missed opportunity. And likewise, it works the other way. If I see a stock and I know it's on its way up today, the news is really hot on it, I'm going to buy it, 100,000 shares of it, but there's only 50,000 available, so now I can't. So I just lost opportunity there as well to make money for my investors. So not only do we have commission costs, bid-ask spread costs, we have market impact costs, and we have these opportunity costs. So these are the hidden costs that make up all these extra costs in buying and selling of stocks in a mutual fund that we don't ever see. So how do we quantify these costs? Because the higher the costs are, the more value the manager will need to add in his or her security selection and trading decisions to make the investment worthwhile. So what they're saying here is that for a money manager to make money for you and I, the investor, he's got to trade, buy and sell, and make good moves that much better, because all these costs are like an anchor. Okay? It's an anchor. It keeps us as the investor from making money. And so what they're saying is, if you compare that to buying a passive index fund, you're going to eliminate all that buying and selling and trading. Our portfolios are not actively traded. American Funds was actively traded. There's a whole bunch of them. Most of them are all actively traded. But unless you go into index funds, you're going to eliminate the active trading, which is what we're trying to eliminate, that extra cost. It may not seem like a lot, but it might be 1 or 2%. 1 or 2% in a year is a big difference over a period of time. So Russell Cannell, who's the director of research at Morningstar, says when a fund has high trading costs, that's a high hurdle to clear when coupled with an expense ratio. So we still have our expense ratio out here, 0.86, 0.5, 0.75, and then we got all these trading costs going on over there on the other side. So how does an investor figure out what to do with this? What do we do? I mean, how are we ever going to figure that out? Because we don't know we don't know where to find what kind of trading costs in XYZ mutual fund. So what you have to do is you have to look at turnover. What is turnover? Turnover is money managers buying stock and selling stock. Okay, that's called a round trip. If I buy a share of stock and turn around and sell it, that's a round trip, full round trip. That creates turnover. So every time there's turnover, then that creates costs, right? Commission costs, bid-ask spread, could be market impact, could be opportunity costs involved there. So turnover is a way for you and I, as an investor, to go out and try to figure out what is really happening with this particular mutual fund. Are these guys psychotic and they're buying and selling and trading like crazy? And there's a lot of that going on because there's a lot of money being made. In fact, Matson said when he went in to open up his free market mutual funds, he had to go to a broker-dealer to find somebody to handle the marketing of his mutual funds. He ended up doing it with Bank of New York, is the custodian of the mutual funds for the free market funds. When he first went out, he went to broker-dealers, and the broker-dealers that do this stuff said, well, how much trading costs? How much? It's not, you call it under the table money, it's legal, but he's like, well, we're not going to be doing trading. We're not going to do active trading. And they're like, well, we don't want any part of it because that's where the real money's at. Real money is not custodian your mutual funds. It's we want the trading costs. All the guys, that's where the real money's at. So he had a hard time finding somebody. He ended up going to the Bank of New York because the Bank of New York is a bank and they're not looking, they weren't a broker dealer. They were more interested in getting a fixed amount or a transaction fee kind of thing, instead of a commission kind of thing. So turnover is the only way really an investor can look and see if these guys are really good money managers. So what is turnover? Turnover is that buying and selling a stock. While you can't find a fund's total trading related costs, you can get a clue from a standard and imperfect measure of how much trading the fund is doing, and that's called the turnover. Turnover is expressed as a percentage. So if you go online and look any mutual fund up, you can see that if you look in Yahoo at a specific mutual fund, it'll tell you what the turnover percentage is. And turnover is what creates all the costs. So the more turnover of more than 100% can indicate some very high trading costs. And what 100% turnover means is they've churned the whole portfolio over 100% in that calendar year. So 100% turnover means they've churned everything over one time. That could be lots and lots of trades in a calendar year. So this is Mr. Cannell saying that 100% can indicate trading costs may be on the high side. I think so. In Morningstar, list of the 200 largest U.S. stock funds, the funds with the highest turnover, CGM Focus had a 504% turnover. Now these guys are psychotic, if anybody is. That means they turned the portfolio over 5 times. That's a big mutual fund. American Century Equity Income Fund, pretty popular fund, 296%. That's almost 3 times they churned that whole portfolio over. This is happening like crazy now. And so you got to look, when you're looking at these mutual funds, you got to get in there and look at that turnover, because that's going to tell you who the psychotic guys are that are just trying to really roll and make cash no matter what. Obviously, the investors are not the number one concern here. It's about how we're going to make a buck. Of the 32 funds that had turnover above 100%, this is 2010, 11 were from Fidelity. And the topped by Fidelity, the Advisor Midcap had a 244% turnover. So almost 2.5 times Fidelity Midcap turned over the portfolio. So even the big names that you hear about are also very, again, it's all about making money. That's just one, these are just one mutual fund of a family of lots of them. So turnover can be extremely detrimental to a portfolio, obviously, because we have those 4 hidden costs in there. So the other piece of the puzzle, remember at the beginning I said we have hidden costs and we have investor behavior. So cost of capital looks simple. If I'm this guy, this corporation, and I want to get investors in there, and I'm the investor, and I want to invest in this guy's corporation, and I'm going to buy some stock in your corporation, but maybe I can't buy it myself, so I'm going to go through a mutual fund that's, a lot of times these corporations will go to mutual fund money managers because they'll buy large blocks. They can raise capital very quickly if you have a mutual fund manager that wants to buy your stock, as opposed to going out to individual investors like us. So investor behavior is the other piece of the puzzle. If I'm the investor buying that stock, okay, I'm going to go through a mutual fund. I got all these mutual fund costs. Now all of a sudden, there's another piece of the component that we don't even think about, and that's investor behavior. So let's look at the formula of what cost of capital is, and then we'll go into what investor behavior is. So what is the cost of capital? Cost of capital is basically, if I'm a corporation, I'm going to raise cash, I need to know what it's going to cost me to get that cash. That's cost of capital. And cost of capital is equal to return of capital. So if I'm the investor, so cost of capital is the corporation guy looking at it going, what's going to cost me to get this money from people? And then return on capital is the investor going, what's going to be the return if I give you the money? So they're equal. But what happens in this cost of capital, return on capital equation is the actual real net return to the investor is minus investor expenses, these hidden costs, and minus the behavior penalty. So it's not as simple as you think. If I go in and I'm going to buy this mutual fund that's done so well, and maybe the next few slides will tell us a little bit more about that, but if I'm going to go in and buy this mutual fund, I'm going to expect an 8% return. Maybe I haven't even thought about these two things. I may not get 8%. I may think it looks good on paper. I probably should get 8% on average on this, but have I looked at all the real hidden costs and things there? So here is a study by Dalbar. This is the end of 12s. It comes out about this time of year every year, so we don't have 13s yet. I tried to pull that up today, but we don't have it. They have part of it, but they don't have the whole study, so we can't show any part of it without the whole study. But the S&P 500, Dalbar is a third party. They do a study every year, rolling in 20-year periods. 20 years, the next year they do 20 years, the next year 20 years, trying to find out, it's a study on investor behavior. How are investors really, how are their returns really, what are they really getting in reality? Because, we've talked about track record investing. So if you go in and you look at, and I run into this all the time, people come in with their 401ks and they'll go, oh, look at these mutual funds, the last 20 years, this has done 17.2%. Well, in these slides, we don't talk about it, but there is some segments in some of the classes that we have that if the mutual fund might be around for 20 years and the average return is 17.5%, I'm just going to throw that as an example. But what happens is in the beginning of that 20-year period, when that mutual fund first started, there's nobody really has ever heard of them, right? So they have these expenses, but they have a lot of great returns in that initial 5 to 10-year period. Well, once they start having these really good returns, then all of a sudden their name gets in the paper and people start going, ooh, I want to buy that, I want to buy that, I want to buy that. And so the stock or the mutual fund keeps going up and up and up, gets more money inflows. They can buy more stocks, and so they start doing better and better. And then all of a sudden we have a market crash and it goes down and it starts all over. So in that 20-year period, if it's 17.5% as a return, if I'm looking at the track record of that mutual fund since its inception, 17.5%, what did the investors really make there? How many people were really in it that whole 20-year period? They might not have got into it till 15 years into it. And then all of a sudden it drops 2 years into it, 20%, and did they really make any money? So the track record investing that we talk about is very critical because we look at this and go, well, that mutual fund's done really good the last 20 years. I'm going to buy that. But in reality, that's just what that mutual fund's done if you were in there from day one till the end of that 20-year period. So if we look at, so what Morningstar says is, what do investors actually really make? So they have to do this a great deal of research. Dalbar does this great deal of research trying to figure out what do investors really make without looking at what the mutual fund says they did over the last 20 years. So this is a rolling period. The one that's going to come out here pretty soon will be 94 to 2013, and they do this every 20 years to find out what's going on. So the S&P 500 from this 20-year period right here did 8.21. No expenses, nothing. That was just what that's what it averaged every year, the S&P 500 from that period of time. The average investor expense per year for that period of time was 2.85. This is all those hidden costs we talked about plus the management fees. So the average cost per year during that period of time, this is done again by Dalbar, 2.85. Investor behavior is 1.11. So remember I said cost of capital minus expenses minus investor behavior. What is investor behavior? Is us sporadically getting in and out, trying to time the market part of it. So in other words, that we didn't buy into that mutual fund for the first 7 or 8 or 10 years because it really, was a new fund. I wasn't going to get into it. I don't know how well it's going to do, or I don't even know about it. And then I get in after the market's already run up with that mutual fund, and then it drops down. So that's market timing, right? We're trying to time to get in based on the track record. So investor behavior penalty during that 20-year period is 1.1. That's our own fault. This is investor behavior because we can't seem to grasp and hold on to something for a long period of time. And I'm not just talking about investors, I'm talking about advisors. So let's do the math. So 8.21 is what the S&P 500 did over that 20-year period. You take out the 285 for the expenses, and you take out the 1.1 for investor behavior. The actual real return over that 20-year period was 4.25%. This year, what I saw without these pieces, they estimated it to be a little over 5% for 2013. Again, I haven't seen all the pieces, so I can't really quote it and say that's exactly what it is, but it should be finalized soon. So 4.25 out of 8.21. These are our costs that we don't even think about when we're going to invest our capital. But the whole industry makes it look really good, doesn't it? Shows you how well that mutual fund's done, but they don't tell you all the costs involved in it. Does that make sense? So the return on average equity investor over the last 20 years, 4.25%. And if you just bought in the S&P 500 stocks after expenses and behavior, because we can't sit still, right? I don't know. Most of you guys are regular class attendees, so maybe you've kind of gripped on to that fact that we're trying to get away from all that. It's too hard to time anymore. It's too hard to buy individual stocks and buy and sell and trade. Now, if you want to buy stocks and hold on to it, maybe, but there's only a certain segment of your portfolios you got to be careful with those too, because you got to still beat inflation. And sometimes the dividends aren't beating inflation. Anybody got any questions on the cost of capital? No? Was it that easy? I'll just give you a couple numbers here. Our fixed income, the free market fixed income fund that's in your portfolio has a 1%, just to give you an idea what turnover is. We talked about 100% turnover, 500% turnover. Our turnover in our fixed income fund is 1%. Turnover in the U.S. stock fund is 4%. and the turnover in our international fund is 3%. We've practically eliminated all the costs of turnover because there's just very little turnover. It's so minimal that it's just minute. Thought I'd throw that out there a little bit because I thought it was pretty cool how, and if you start to buy, we're not buying just index funds. I mean, there's index funds in our portfolios, but a lot of it is asset allocated. So in other words, they're buying different size of assets and allocating in certain percentages. So it's not just buying index mutual funds. If you bought index mutual funds, you might have more turnover. Because if I buy just the S&P 500 index mutual fund, every year they got to reconstitute that S&P 500. That means they got to look at those 500 corporations and go, okay, who we booting out and who we putting in. So they create turnover right there. And the problem with that, yes?
So is that turnover, is that from just the rebalancing of the portfolio? Or where does that turnover come from, that 4% or whatever?
Mostly rebalancing, but what you'll have is different asset classes. Let's say you have a stock that goes from a small cap stock and now becomes a large cap stock because the company grew. So now you have to sell it out of the small cap segment. You might keep it, or you might buy another small cap and get rid of that one. So that creates some turnover. Most of it's from the growth of those companies that go to a different asset class. That's the bulk of it. And rebalancing can create some turnover, yes, but it's very minimal. One thing, we did a class on rebalancing one time. Maybe I should revisit it again. But it's pretty interesting how Matson rebalances, because when money comes in every day, they rebalance those funds. So they're not selling anything to rebalance. It's an amazing process. And it's a 40-minute presentation to really get a grip on it. Sometime we should probably revisit that one. But that's what turnover is. Now you lost my train of thought, son. Can you take over? Yeah, no, I knew what that was, but I'm just trying to figure out where I was going with that whole thing. Anyhow, any questions?
No more, sorry.
We were talking about, well, okay, doesn't matter. It'll come back to me. See, that's why the young blood's coming in here. 56 now. Starting to kick in already. All right, we're going to go over the 20 must-answer questions real quickly. It's in the back of your booklet. Yes, no. Very simple. If you know the answer, it's yes. If you don't, it's a no. If you don't know all of it, it's a no. We're going to teach the young one what this is all about. Have you discovered your true purpose for money, that which is more important than money itself? Do you know what's more important than money to you? We all have this tendency, we want to see our accounts grow and grow and grow, and that's important to us. But sometimes we don't become happy when they don't grow and grow and grow, right? Because the market does go down, right? It can disappoint us. So in that case, we need to have a true purpose for our money, a real reason. Is it gifting? There's a whole class that I did, and we can do again on this, and I'd like to do it again if I thought I could get enough people to do it. And it just whittles down to what your true purpose for money is. So if you know what that is, great. If you don't, then that's a no. Are you invested in the market? Well, if any of you guys have equities, then you're invested in the market. Any mutual funds with us, you're invested in the market. Do you know how markets work? Well, we talked a little bit about that today. May not cover all of it, but if you keep coming to the education classes, you'll start to get a grip of how markets work. Today we talked about some of the hidden expenses in the market, which is huge. Huge, 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 huge. Have you defined your investment philosophy? Most of you sat down. If you went into the Matson money portfolios, we have talked about investment philosophy, which is a more passive approach to investing, rebalance every 3 months. We're not trying to predict, we're not trying to speculate, we're not trying to pick stocks. We're not going to get psychotic on you. Okay, maybe a little bit. But we're going to try not to get psychotic when it comes to the trading. It's just added cost. There's no reason to do that. We can do just as well and beat most of them by not doing that. Have you identified your personal risk tolerance? Do you know what your standard deviation is? What kind of risk you're taking? Whatever portfolio we put you in, we went through the process to learn what risk tolerance you're willing to take. Do you know how to measure diversification in your portfolio? To have 20,000 shares of stock in your portfolio does not really mean that you're diversified. If you go back, and I just ran some American funds, I keep picking on American funds, but that's because we left American funds or stopped using them. I just ran a MRI on someone who had 4 American funds, and the top 50 holdings in those 4 American mutual funds, all 4 of them, the top 50 holdings, all 4 of them own the same stuff. I'm like, really? That's not diversification. How can it be diversification if I buy this mutual fund, it has the same thing as this one, at least my top 50 holdings, which is the majority of my money in there. I'm not diversified. So do you know how to measure diversification? It doesn't mean if I have a whole lot of stuff in there that I'm fully diversified. You got to look at the academic histories of what real true diversification is. Do you consistently and predictably achieve market returns? That's your benchmarking. Is your portfolio beating what it's benchmarked to? Have you measured the total amount of commissions and costs in your portfolio? Well, we talked a little bit about today. Now, it doesn't give you the idea what your total costs are, but have you measured it? And most of us, when we sat down and went in the Matson, should know what your costs are. If you don't, come in and see us and I'll give you a right down to the 0.1%. Do you know where you fall in the Markowitz efficient frontier? Remember the curve we talked about? Whether you're aggressive risk down to a conservative risk, where do I fall on that curve? If you aren't sure, then check no. If you do know, check yes. And if you don't know, then call and come in and we'll go over stuff, because that means it's time for a review. When it comes to building your investment portfolio, do you know exactly what you're doing and why? That's what we try to do with our education classes, and we try to do when we meet, is to make sure that you're educated and understanding of what we're doing, not just shoving something across the table and going, here's what we think you should be in. I appreciate you trusting us, but we think you should do this. We want your skin in the game. That's the coaching process. Help you to understand why you're doing what you're doing. If you don't feel comfortable with that, then we need to get together and talk about that. Are you working with a financial coach versus a financial planner? There's one of the things Lori brings up a lot. Financial coach is basically helping you understand and educate you of why we're doing what we're doing. Financial planner says this is what you need to do, and you just trust them and you do it. That's okay for some people, but do you really know what you're doing? Do you really understand every aspect of all that? Do you have a customized lifelong game plan to guide you all the way through your investing and spending decisions? Have you done any game planning on why each account, what is the purpose of that account? The idea is to have purpose and meaning for each piece of that puzzle. Do you have an investment policy statement? Everybody has a Matson portfolio, has an investment policy statement. It's the whole process of how much risk we're willing to take, all the way down to the style and the portfolio that we're picking. And if you don't sure what that is, we'd be glad to go over it with you guys. Have you devised a clear-cut method for measuring the success or failure of your portfolio? How do you know if your portfolio is doing any good or not? Other than, okay, it's making money. We're all happy when it's up, right? That's the happy volatility. We're never happy when it's going down, but that's part of the game. We just got to be able to manage that when it's down. How do we behaviorally manage that? And that part of that is knowing whether you're being successful in what you're designing your portfolio. Do you fully understand the implications and applications of diversification? Again, back to this thing, a lot of stuff doesn't mean that I'm really well diversified. Stuff moves in different movements. Small cap stocks might be up when large cap stocks are down. That might be in one country, might be up when another country's down. This is true diversification. Do you have a system to measure portfolio volatility? How big of a roller coaster ride am I going to be on? And we've all talked about it. What's your expected return? What's your expected loss? What's your worst case scenario historically? Past performance is not indicative of future performance, of course, but when we went down and figured out what your portfolio mix is, we talked about what the standard deviation is. Here's what your expected return should be. Here's your expected losses on average. And here's a worst case 2008 scenario. Doesn't mean it's going to happen tomorrow or the next 20 years the same way, but those are things that, I mean, what else do we have to go by? We have to go by something, so we go by history. So how do we measure that volatility? Because right now everything's going good and we're happy, but when the wind stops blowing, then we got to go, oh, volatility's not so good. Were we in the right place? We want to make sure we're in the right place before the market goes down so that we can handle it when it is down. Are you aware of the costs associated with purchasing commission-based products? Again, we just talked about costs and commission. We've worked our way out of the commission world. Do you know the 3 warning signs you may be speculating with your money versus prudently investing it? Speculating money is the buying and selling, the active trading of mutual funds. Money managers do it all day long. They think that they found the little magic, we're going to buy some of this because we think it's going to be hot for the next 6 months. Doesn't mean they won't hit it, but can they hit it consistently over and over? It's pretty hard to do because we don't know what's going to happen. And they don't have a crystal ball any more than you and I do. Can you identify the cultural messages and personal mindsets about money that destroy your investing peace of mind? What kind of mindsets do you have that keep you from being happy about your money? Sometimes we let that money overpower our happiness in our daily lives. So we're going to talk about, well, part of this coming to the classes on a regular basis is to help you get out of that scarcity mode and think about the abundant mode. And the abundant mode is not necessarily money. It's about being happy and knowing what the true purpose of your life is above and beyond money. Sometimes that takes us away from obsessing on our account values when the market's in a big decline. We don't know when that's going to happen, but I can tell you right now, it will happen. We'll have another market decline. I have no idea when. Could happen tomorrow. All I know, it didn't happen today. Could happen tomorrow, could happen 6 months from now, could happen 5 years from now. Nobody has a crystal ball. The markets the economic indicators are all very good right now. Things are really doing pretty good. And we still don't have overconfidence, which is, to me, is a good thing. Sometimes it's not a good thing, but to me it's a good thing in the markets when we don't have overconfidence, because when everybody's overconfident, everybody's going to the market, running the market up. That creates the bubble. So as long as we still have this somewhat lack of confidence, the markets aren't getting run up crazily. And this year we're about flat. So if anybody's watched your accounts this year, you shouldn't be. But if you have, we're about flat from the beginning of the year. Good part of that is what corrections we've had in the market so far this year have not taken away what we made last year. That's the number one thing I look at, and we'll see how the rest of the year goes. It is a political year. I think it's a tipping point in the political system right now. A lot of decisions need to be made this fall, and we'll see where the American public's at. Even though it's not a presidential election, there's certainly a lot of good stuff on the line for this fall. Who knows what will happen? Any questions? Nothing? I'm done. Unless anybody has anything else.
You taught us too well, Dad. Everybody knows.
I don't know.
Well, you answered my question.
You guys are permitted to leave now and stick around and talk if you want. Ask any questions you want. I feel like a professor here. Class is dismissed. It is 80 degrees out, maybe still, hopefully.